Hello and welcome to this week market dashboard. We are August 30th, 2025, in a week that was pretty quiet overall after Powell's speech in Jackson Hole last week, indicating rate cuts for September, and in the context of the Nvidia results. So pretty quiet, but a couple of things happened under the hood, and we'll take a look. So the week was pretty quiet for major asset classes such as equities, bonds, currencies, and even oil, which is very often much more volatile than the other asset classes. The impact of the Powell speech last week was mostly felt last Friday, with a big upside, specifically on equities, when the Nvidia earning reports this week didn't have much impact. It was slightly above expectations, so a little bit of shake, normal shake around the announcement, but nothing really material. However, the biggest impact was felt on gold, with Powell indicating rate cuts in a context where the inflation is not constrained, and that may trigger another round of inflation. Powell decided to favor the economy and the employment environment rather than control inflation. So obviously this has an impact on gold, which went up about 2.5% this week. At the same time, Bitcoin went down a little more than 7%. I've seen comments saying that, well, Bitcoin is not a safe asset. Well, I would say it's never been. Actually, before 2020, Bitcoin's correlation with equity markets were around zero, hovering around zero, in a nearly constrained range between minus and plus 10%. But after 2020, Bitcoin established itself as a beta and risk-on asset with correlation with equity markets consistently positive and at a higher level, around slightly below, between 40 and 50% correlation with equity markets. So not only Bitcoin has never been a safe asset, but you can definitely say that it's not anymore at all. If we look at equities specifically in detail, we can see that US equities being nearly flat for the week, with small caps overperforming larger caps such as Nasdaq and the S&P 500. The major thing this week on equities is about foreign equities such as emerging markets, global equities except the US and Euro stocks, for instance, which all have underperformed the US equity markets this week. And this seems to be, we've seen quite a few times that since the beginning of the year, the foreign and European equity markets had overperformed the US equity markets in a very specific environment governed by tariff fear. Now we seem to go back to business as usual, I would say, where European and foreign markets are underperforming the US equity markets long term, which is kind of normal, I would say, considering that the US equity market is still the market that is attracting the most assets from around the world. Last few points on equity markets, we've seen it already, but strong recovery of the small caps versus the other indices. Of course, it comes from better financing conditions from Powell anticipating rate cuts for September. So they are, small caps are the most sensitive to financing condition. Now, if we look at sectors, we can also see that the sectors that strongly, significantly underperformed this week were defensive sectors from the S&P 500. The offensive sectors were more mixed in a flat week, but defensive sector definitely underperformed, which we will see at the end of the video can indicate some form of complacency in the market, specifically if we look at volatility and breadth indicators. Now for bonds, despite Powell indicating rate cuts for September, the week was pretty muted for bonds. Short term slightly up, longer term bonds slightly down, so interest rates up for longer term bonds. There's no indication that Powell cutting rates will have a significant impacts on the rates of the bonds themselves. If you remember what happened last year when Powell cut rates right before the election, what happened is that bond yields went actually up in anticipation of more inflation, and this is exactly what may happen again this time. The crypto sector was down this week. The excitement after Powell's speech last week was quite short-lived. Actually, as soon as last weekend, cryptocurrencies were already down and continued going down this week. We are still not very far from the all-time high, specifically for Bitcoin. We've seen that Ethereum has recovered very significantly recently. Everyone was waiting for an altcoin season, which actually may not happen if Bitcoin is struggling. However, I think the news of the death of Bitcoin are again largely exaggerated. We are only down 15% from the top, maybe slightly more than 50% from the top on a daily basis, only 9% on a weekly basis, whatever. But the point is that historically, the median drawdown for Bitcoin is around 50%, which means that half of the time we are more than 50% away from the all-time highs in Bitcoin, and this didn't prevent Bitcoin from generating a lot of performance for holders. So considering Bitcoin's volatility, a 15% drawdown is no reason to panic at this time. It doesn't mean that it will go up. It doesn't mean that it won't go down. It can definitely, but it's very early to call this a crash. It's kind of part of its natural volatility. And again, historically, that kind of drawdown, meaning distance from all-time highs, is pretty small. So in conclusion, in a week that really looked pretty inactive in terms of market variation, we have a lot of indicator not indicating much risk actually. Market activity is pretty low. The volatility of equities, the VIX, is compressed. The term structure of the volatility is pretty steep at this time. The average pairwise correlation between major assets is pretty low. The greed fear index is pretty neutral. So we have a lot of indicators based on prices that tell us that at this time the risk is not high. Of course, we know that it can change very rapidly. If we look at equity markets, we are in a kind of ascending wedge at this time, which may trigger a sell-off when we get out of it. Obviously, no one can predict the future, but this is the kind of thing that happened in the market, and specifically when everything is looking good and is looking too good to be true, it can sometimes be too good to be true. And we are entering a period of the year where the market volatility is often higher. In terms of seasonality, September is not really good for equity markets. So I believe that at this time, we should stay focused on the markets and things that can potentially change pretty rapidly. Thank you for being here, and see you next week.